Welcome everyone to today's edition of IREI Live. My name is Jeff Dorman and I'm the CEO of Institutional Real Estate Inc., the producer of these webinars. Today's program on the evolution of defined benefit pension funds and its impact on the creation of real estate and other alternative investment vehicles tailored to meet the needs of those funds is underwritten by the following sponsors: Bentall Green Oak, Clarion Partners, Heitman, Invesco Real Estate, JP Morgan Investment Management, and Nuveen Real Estate. We'd like to thank these sponsors not only for underwriting today's program, but also for helping to organize and curate its content. I should also note that although this program has been underwritten, our sponsors all understand that these sessions are designed to be educational and not platforms for marketing. So our traditional no marketing policy for all of our events will still be very much enforced throughout. So what's all this about? As you probably are aware if you've been paying attention to us, for more than 20 years, we've been warning members of the investment management and consulting communities that the cow you've been milking, the defined benefit pension cow, has been getting skinnier and skinnier as more and more plan sponsors have frozen their defined benefit pension plans, leaving only the option for newer employees to participate in their defined contribution plans. To cite some statistics, according to the Department of Labor in 1975, there were 103,346 defined benefit pension plans and 207,748 defined contribution plans. So already by 1975, DC plans outnumbered DB plans by more than 2 to 1. By 2018, the number of DP plans remaining had shrunk to less than 47,000, while the number of DC plans had grown to more than 675,000. Again, according to the DOL, in 1975, DP plans controlled nearly 186 billion in total assets, while DC plans only controlled just under 75 billion. And while the number of DB plans shrunk, that didn't stop DB assets from growing. DC plans just continue to grow at a much faster pace. So by 2018, for example, DB plans controlled slightly under 3 trillion in assets, while DC plans controlled well over 6 trillion, more than double. And annual contributions to DC plans by that time were almost 10 times greater on an annual basis than contributions to DB plans. And this is still an ongoing process. DB plan sponsors will continue to freeze their plans, leaving their employees only DC options. And asset growth for DB plans will continue to slow, while asset growth for DC plans will continue to accelerate. So hopefully you can see the pattern and imagine the implications for all of us in the business of serving institutional investors like this. Because clearly this huge shift that's been underway over the past 50 years has had and will continue to have even more dramatic impacts on how capital is formed and flows to the real estate sector from these investors. So to discuss these trends and their implications, to kick off this webinar, allow me to introduce Loretta Clodfelter, our senior editor and editor of our flagship publication, Institutional Real Estate Americas, who in turn will introduce her panel and explain how you as audience members can participate in the discussion by posting comments to or questions for the panelists. Loretta?
Hi, thank you, Jeff. And thank you for laying out the situation that we have and the evolution of this market. This is real estate opportunity sets in the defined contribution market. As Jeff was describing, we're going to look at the defined benefit and defined contribution models and examine how trends in these markets are reshaping private real estate investment options, investment programs, and investor roles. So this webinar should provide you with insights into the key trends and review a number of different strategies and solutions available in real estate today. The first panel, we will review the evolution of the defined contribution market, as well as the different approaches to real estate investment, how that's involved. In the second panel, we're going to dig into the latest trends in defined contribution plans, what they mean for real estate investment. And in the third panel, we're going to explore the implementation of private real estate investment in defined contribution plans with a case study on how to make it happen. So I'd like to start by welcoming the members of our first panel, Sean, Josh, and Allison, if you could join us now. All right, thank you. Let's start with some introductions. I'm going to go around to each of you and ask you to just do a sort of a brief introduction of name, title, and kind of what your role and how that fits into this defined contribution story that we're telling today. So I'm going to start with Allison.
Great, thanks, Loretta. Hi, my name is Allison Yeager, and I'm with Mercer a global consulting firm, and we work with clients across the world on an advisory and discretionary basis. I head the global real estate team. And so we work with all of our consultants and clients that are looking to use real estate for whatever pool of capital they have, whether it's DC, DB, endowments, foundations, et cetera.
Sean?
Hello, everybody. My name is Sean Lees. I'm the Chief Investment Officer and Head of Funds Management for Nuveen Real Estate. Nuveen Real Estate is a global real estate investment manager. And we've been involved with DC plans for about 25 years or so.
And Josh?
Hi, my name is Josh Samolo, Managing Director and Head of U.S. Distribution at Bensall Green Oak. We are a roughly $70 billion global real estate platform. And I have a long background in the defined contribution world and head up our DC efforts here at Bensall Green Oak.
40 years ago, as Jeff was describing, legislation was introduced allowing for 401k plans, which is sort of what we think of as the sort of the cornerstone of the defined contribution market, although there are, of course, other plans as well. Since then, we've seen, a huge growth in that market, as Jeff has described. And these are very separate from the defined benefit plan market, which are freezing, closing, shrinking. Although their assets remain growing, they're shrinking to existing people. Can each of you kind of maybe talk a little bit about this evolution and how it's created the current market realities for private real estate investment in defined contribution plans? And I'm going to start with Allison, because you have a sort of a different perspective, being as you are consulting and offering advice for both DB and DC plans. How has this evolved, and what do you see in the market?
Yeah, obviously, we've seen a huge growth in the number of DC plans and the assets within those plans. So across asset classes, we're always looking about the best execution for those participants. We feel like DC participants deserve the opportunity to have a well-managed portfolio, just like the DB plans have seen. And obviously, those have been more institutionally staff managed, so a little more difficult if it's participant directed. And I think that we're making progress in regards to having private real estate added in DC plans, but we still have a ways to go. A lot of the progress that we've made in making valuations more transparent, more timely, providing mid-term valuation adjustments and those types of things are definitely steps in the right direction. And as we'll get into it, I'm sure the other panels will too, we still have questions about liquidity and how to address that. And also fees. Unfortunately, no one loves to talk about fees, but that's definitely something that will continue to be an issue for DC participants, and that's a huge issue right now across all asset classes for DC participants.
Josh, can you add some thoughts on this?
Sure. So, if I look back to early in my career in the early 90s, the 401k plans were started really as supplemental plans to DB, right, as a way to kind of reduce your taxable income and offer some additional savings. But they definitely evolved into, as we've seen for a lot of industries, probably most of the professionals on here, that as their primary source of retirement income. And I think that there's a challenge on participants who don't necessarily have all the same tools in their toolbox that the DB plans can use, and that's the access to private market investments. So I think there's a challenge for participants, and again, the burden has been put on to participants to kind of stake out their own retirement, as opposed to the DB world where you kind of knew your formula, you knew after years of service what you'd get. So to me, it's a fundamental shift, and the risk is on the participant, and I don't think they're armed as well as they could be in the DC world.
Well, absolutely. It's the difference between being an investment expert and just being someone who's going to retire someday. Those are two very different skill sets. Sean, do you have some thoughts as well?
Yeah, I would go a little bit further. And I think the other thing that makes DC plans difficult or problematic in some respects for investors these days is not only just, are you going to make good, sound investment decisions and get the benefit of say, real assets exposure that the DB plans have slowly migrated into, But additionally, it's also just how much are you saving? Are you putting enough aside, right? That's all been taken care of by the DB plans. And so, you know, you have the quantity that you're putting aside every year. You say, okay, gosh, what's my free cash flow that I've got that I can actually invest here? So that's a first decision they need to make. There's also, we've seen a lot of people, you know, have events in their lives where they're going to have to either withdraw that money prematurely and get penalized, or they're going to have to borrow against it, right? And there's generally structures put in place for that. And so for any one of these reasons, there's a number of things that can be quite difficult. And you know, to the extent that we can bring the benefits of real assets to the DC space, I think that's a real benefit for everybody.
Yeah, let's maybe talk a little bit about those benefits. Why should defined contribution plans include alternatives such as private real estate? Sean or Josh, you want to start with that?
I'll kick it off if that's okay. I mean, I think that there are probably at least 5 reasons why anybody would want to invest in real estate, and whether it's through a DB plan, whether it's for your own personal investment, or whether it's through a DC plan, right? Those same reasons apply. And the first one is income, right? It's a great source of income. Number 2 is you have the opportunity for capital appreciation. 3 is diversification. You know, 4 is low volatility, so relatively strong risk-adjusted return. And then number 5 is really kind of an inflation protection. It's funny because, you know, that last one, inflation protection, was something that I think for about 30 years, it was always in that number 5 position. And I think maybe now that jumps up to number 2. I don't know, at least in the United States, you know, depending upon what you hear the Fed saying, I certainly feel that inflation is going around. But we think that what you're able to do is when you combine real estate with, you know, your classic equity and debt investments, right, can push the efficient frontier up a little bit further.
And Josh, I know Sean just said it all, but maybe you can add some color here.
Yeah, so no, Sean did say it all, but what I would add is that if you look at the macro environment right now, where fixed income is, you know, with our defined benefit clients, we are seeing clients actually kind of peel back their fixed income a little and add to core real estate, right? Because of all the reasons, you know, Sean talked about and where the macro environment is. So it's just a natural progression, I think, for DC plan participants to get the same access to be able to make those adjustments. And again, we're talking about not necessarily a participant on the plan menu making their own adjustments to their own portfolio, but you know, the private real estate being a sleeve within a broader multi-asset strategy, like a target date fund or a custom balance fund, or what have you.
Yeah, and I'll just add to that, Loretta. I think all of us on this call would probably be able to expound on the real estate benefits and why it should be part of it. But, you know, it's different in the DC world. And not only, as Josh mentioned, you have to get past the committees, but you have to get through the plan participants. And they don't go through asset allocation studies like you always do on the DB side. So, you know, it's a different level of education and multiple levels of education that you need to go through before you even talk about liquidity and terms and fees or anything like that. But the whole process of making those asset allocation decisions is different for a DC participant who's not trained in the investment world and how to make investment choices than it is in the DB world.
Absolutely. And, you know, you talk about, if we look back to the last 20 years, you know, 20 years ago, the 401k options were maybe a supermarket menu of different funds that the plan participant had to click through. Now we're seeing more multi-asset strategies. How has that changed or provided sort of a different opportunity for private real estate investment? I might go back to Allison for that, and then we'll work our way around. Yeah, sure.
So, you know, I think the way that we have used private real estate for our clients and their DC portfolios has been more in the multi-asset and the target date funds. That helps to be able to deal with those liquidity issues. And even though you educate and explain terms and everything around liquidity in particular and fees, it's much easier to administer, we believe, in those types of funds. So that's a good way of doing that. And as I mentioned before, you know, we've made strides in getting to where we need to be with daily valuations. So obviously that's something that needs to be done. and seeing good progress there with just making sure that different ways to conduct those daily evaluations have improved and been documented as well. So I think liquidity is something that still has to be addressed, particularly if you have a DC plan and you want it to be a standalone option. I think there's still some issues around that, and we're trying to figure out how you ensure that the education and the participants actually understand what the terms are and how to deal with that.
So it sounds like the shift toward more multi-asset plans to target date funds and similar has had a real big impact for the opportunities around the private real estate. I see you nodding, Josh, as well. Do you have something to add there?
Yeah, as you've seen, as QDIAs or default funds capture the majority of the capital that comes into DC plans, I think that lends the opportunity, as Allison pointed out, there are a lot of challenges with DC plans because of the employee communication that goes around it, right? Every time a new fund is offered, there's communication out to the employees, very different than the DB world where you can kind of pull your managers in and out and there's not much of disruption to the employee base. So that's something that we're always cognizant of. And the ability to add private real estate as a sleeve within a broader multi-asset strategy, it's just a little bit, I think it's a great first step to get private real estate exposure for DC plan participants. But certainly the way most of the products are structured out there is that I don't believe there's a real private real estate fund that's able to be a participant option because of the liquidity concerns and able to handle the amount of liquidity you would need to handle participant withdrawals. So, the funds are structured to be part of a broader multi-asset strategy where you have a fiduciary managing that liquidity, managing the allocation so that there isn't, you don't run into a liquidity lock where a participant can't access their money, therefore blowing up a trade and then creating a cascade of issues throughout the retirement plan.
Yeah, Sean, additional thoughts here?
Yeah, I think what we're seeing a little bit is, to the extent that you're offering up just a pure play real estate option that a 401k plan can invest in, we find that the investors think of it as just, hey, that's just my real estate exposure. And we see a much higher level of sophistication when you're going to a multi-asset manager or some kind of plan. And then what happens is that dialogue isn't about just, oh, hey, there's our real estate, but it basically comes down to what types of sectors am I going to be getting exposure to? And that's where it gets kind of interesting, because then you start talking about the allocations among different sectors within those pool of assets that you're investing in. And that's super, super, super critical today, especially when you see what's happened during the COVID recession, right? Because you had this massive wild dispersion of performance between the best performing asset classes and the worst performing asset classes. And that's different than I think we've seen like during the GFC, all real estate just kind of fell. And so to just get real estate, maybe it was a little truer to say, hey, real estate was just real estate. But, this time around, if you had anything that was, overweighted to industrial and to multifamily, your performance was exceptional. If you had more office and retail on the other hand, you're probably suffering a little bit. And so it's kind of interesting now when you get, those multi-asset managers where they're actually making the allocations and you can have that dialogue with them and create the right pool of assets for them.
And so, we talk about target date funds. Does anyone want to kind of tackle a quick explanation of the target date fund? I assume most of our audience is familiar with it, but would anyone want to do a quick short? Oh, Sean's sitting in the dark.
Sorry guys, hang on. I've got automatic lights here. They'll turn back on eventually.
Very, very energy efficient, though. We applaud. Josh or Allison, maybe you want to hit a quick.
Sure. Just to describe generally what a target date fund is.
Just for our audience, just the real basic 2-sentence description.
Yeah. So it's, to me, it's a custom age-based asset allocation model that will evolve with your age and take appropriate steps on the glide path to dampen volatility and dampen risk for you as you get closer to retirement, but making the allocations proper to make sure that you have the income and all the components that you need as you work towards retirement.
One of the benefits, it seems, is that it brings in an expert to make those decisions around allocation and retirement planning in a way that your average retiree or hopeful retiree is maybe not making not familiar with the latest allocation information. With that said, can we talk about some of the approaches that we've seen about how to put private real estate into these sort of multi-asset strategies, the target date funds? I understand there's a variety of different approaches for how you might add private real estate to such a plan. Anybody want to tackle that one first?
I'll talk a little bit of some of the ways that we've seen it. The first thing that I think is kind of an interesting dialogue that exists when you're dealing with a target date fund that's investing in real estate is that it does become an issue with liquidity, right? And now, obviously, if you're managing the overall target date fund and you've got equities that you can monetize, or you've got some kind of liquid debt that you can monetize, the liquidity becomes much less of an issue. But what needs to happen is, you're going to have to keep the amount that you've invested, the percentage allocation to real estate, kind of a small slice of that, right? So that doesn't get overwhelmed. The liquidity component of it doesn't get overwhelmed within the overall system. And so one of the elements that's at play there is, inflows and outflows. And by liquidity, it's not just the outflows, but it's also the inflows, and how are you going to manage that? And so, we've seen it's pretty important to try and just have a pure play access to a pool of capital, pool of assets that are, owned by that target date fund directly, right? As opposed to getting into more of a commingled type of a structure. Because a lot of times what will happen is when you then take that target date fund and you go and you talk to consultants, a lot of consultants are going to look at that. And even though it might be, say, 5% or 10% of your fund's allocation, you may spend 50% of your time talking to the consultant about how are you going to handle liquidity in your real estate sleeve. So that just one observation I'll throw out there.
And since we have a consultant here, I'm gonna go over to her and ask her, do you spend a lot of time talking about how the liquidity is achieved?
Well, I don't manage any target date funds. Everyone will be glad to know, or I might have more than the 5 or 10% in real estate, which might not work out well for everyone, but it's definitely something when we talk to our consultants that are managing those or working with clients and other managers in that regards. And the other thing, and I wanted to ask Sean and Josh this as well, is a question I get many times when we're talking about adding private real estate to DC plans through multi-asset funds or whatever the case might be, is about fees. The fees are higher than public market investments, and what kind of conversations have you all had, and is there anything that helps you be able to mitigate kind of that conversation?
Fees, fun. Josh, we're gonna go to you and then we'll come back around to Sean on fees.
Sure. So a couple of points that we make is there is no index for the Odyssey, right? So in order to get private real estate exposure, you have to engage a private real estate manager, and private markets generally cost, I shouldn't say that, that's a blanket statement. In my experience, there could be an increased cost for private markets. There also is a layer of fees for daily valuation. We are paying more to our valuation providers to provide daily for us. So there is a little bit of a premium there. Although, we look at the 100 basis point bogey mark, and a lot of DC plan investors, at least in my experience, like to be under that 100 basis point mark. So to the extent we can structure a product and a plan that can stay in that under 100 and as low as possible under 100, I think that's beneficial to us. But at the end of the day, it is a private market product that you can't replicate it in the Odyssey. So to get exposure, there is a little bit of a premium to be paid, but we hope that we unlock value with the returns and all the other reasons Sean pointed out to earlier. What we bring, what it adds to the portfolio, that it will be net additive for the participants. At the end of the day, we're all here to increase participant outcomes, right? Make them better. So we'd like to think that we help in that direction.
But how do you counter that against what public, what REIT managers are charging, and that they can get the same real estate benefits, obviously with more volatility, but they get the daily valuations, whether you like that type of valuation or not?
Yeah, Allison, when I get that question, I mean, the one thing that one probably needs to do is to look through the G&A costs associated with managing a REIT, right? It's not like this stuff gets done for free, right? So you've got the return that the property is fundamentally delivering, and then you've got all of this overhead, right? You've got SEC compliance if you're a public REIT. You've got all the management teams that you've got to keep happy, and you've got to pay them the same amounts that you pay, private managers or people. If you don't, right, people are going to go and find jobs elsewhere. And so I think if you do the analysis, you're going to find that you are paying a fee to the REIT managers, and then through the G&A line that goes through a lot of those. So that's, it's just that it's so much more blatant when the number is just kind of like clearly stated, on the documentation.
And the one thing I would add to what Sean said, we see the private and REITs being complementary to each other. We don't necessarily think it's one or the other. We do think there's a complementary nature of the two. So I just want to point that out as well.
Maybe we need to do a case study of Australia. Yeah, obviously it's evolved in that market, the use of real estate.
Yeah, the Australian superannuation funds are big investors in real estate on a global basis. Sean, can you talk a little bit about some of the approaches that you've seen? This is something we were talking about, that there are a few different ways that you can come at this. For instance, and we'll be careful around the marketing, but the CIAA has a long history of a real estate investing. How is that different than some of these different approaches that we're seeing?
Well, one of the constituents that we service at TIA is the 403B space, right? And that's really nonprofits and public sector education. And so, there you need to have a little bit of a different structure. And so, you basically would write an annuity product that would be sponsored by the insurance company that's, our parent here, and bring in DC money. And that's when I talk about going back 25 years or so, that's basically how we do it. And that's a little bit different than what you would do in a 401k situation, because you wouldn't be able to offer that same kind of a structure to a 401k type of an investor, nor would something like a CIT necessarily be appropriate for a 403b type of an investor.
And a CIT, that's a collective investment trust, right?
That's right. That's right. But a lot of the same, kind of plumbing that goes into it is still the same, right? So how are you going to manage liquidity? It's still very critical that you've got liquidity mechanisms in place, and people either do that by having certain degrees of liquid investments that they make, or by holding cash, or by holding, or by REITs that you can sell off as appropriate. The same issues though that relate to how are you going to strike a daily NAV apply, and there's a ton of complexity around that. I think Josh mentioned that has a cost to it, and it really does, because what you're really talking about there is not only do you have the valuation of the underlying properties that needs to get done on a regular basis, right? And so a lot of times people might just do it at the end of each quarter, and then whatever those values are, that's what those values are. But a lot more goes into striking the NAV, because you have interest payments that you need to make throughout the period. You have revenue that's collected throughout the period. You're buying properties, you're selling properties, right? And so on a daily basis, you do need to strike a new NAV. You've got the changing in any of the securities that you invest in, the changing price of any of the securities that you invest in. You've got the mark to market on the debt that exists, which is all going to affect what the NAV prices. And that's even though you could have different formats. So whether you've got a vehicle that is just a pure play opportunity for somebody to kind of tick the box and go into real estate, whether it's part of a target date fund, whether it's an annuity product structured for the 403b market, right? A lot of that same kind of plumbing still exists behind the scenes.
And I just want to remind everyone that you can submit questions through the Q&A button, and I am getting some coming in, so I thought this might be a good place to pose one of these questions. How do you plan to diversify within the real estate sleeve within a fund? I think they mean within the real estate portion of a fund, and ask, are there current methodologies that tilt exposures between different real estate food groups within the real estate sleeve? Is it just a sort of a straight core allocation, or do you see that sort of tilt across different property types happening? I think, Sean, you mentioned at the top of the hour that depending on which property type you'd invested in, you'd have a very different experience through the COVID era.
Yeah, I mean, so it depends on what the manager who's ultimately overseeing the planning and what they want, right? If they've got a very strong view on where allocation should be spread and, you know, what exposure at any given time should be made, right? You'll structure something where they can provide some kind of guidance, and then you can implement that and slowly migrate into those allocations. That's not an instantaneous thing, right? It's real estate's not liquid. So you've got to, you know, sell the assets that you want to sell, and hopefully it's the right time to be selling those and migrate over to the exposure that you want to get. And so it depends a little bit on whether you've got a person that's kind of hiring you to do the management of this that wants to allocate themselves. If it's somebody that is saying, hey, I'm going to leave it to you to do this, right? I mean, you'll generally want to have a conversation with them on a periodic basis, certainly at least annually, maybe biannually, quarterly. Give a report on where things are and what you're thinking about where you want to try and migrate the fund. But it's similar to any other vehicle. If you've got a direct pool of assets that are owned. So again, when I was mentioning a target date fund, that could be a situation where they just want to own their assets directly, right? Another way that it can be done is you can have a collective investment trust, and basically that investment trust can invest into a number of different vehicles that are generally built for institutional investors. And, you know, depending upon how those allocations to the different vehicles are made, you're going to get a different risk return profile. It could be different sector exposures that you get. It could be different risk profiles, because it could be that collective investment trust will be making allocations to a core fund or to more of a value add type fund. But the nice thing about doing something along those lines, is that you're going to get greater diversification, right? So if you've only got $100 million, you can get a good diversified pool of assets, you know, a good number of assets, help with the diversification.
Josh or Allison, you want to weigh in here?
Sure. Just from our platform, you know, when we talk about daily value and going into, you know, either target date managers, it's really two parts of the process. There's the underlying core strategy and how we're managing that. I mean, to Sean's point, it's our clients do as much due diligence on our core strategy as they would if they were hiring us for their DB plan. You know, where are our property types? What's our projection? What do we like? What do we don't like? And then there's the daily value piece that kind of slides on top of that. So I think there's a few different ways to do it. You can certainly engage more than one manager with a daily value fund to create diversification and spread the risk around. Or to Sean's point, you can, if you have a platform that has multiple vehicles that feed into their daily value fund, you can create diversification by investing across maybe risk, whether it's majority in core and maybe some core plus or value add. So there are ways to achieve diversification, but I do think at the end of the day, it comes down to a deep analysis on the underlying strategy, right? And what are you doing with that core strategy, or what strategy that's part of that daily value fund? And it's monitored the same way as our DB clients look at it.
And I have a question coming in about evaluation. So I think this might be a good place to sort of bring this in. How much does the valuation methodology drive volatility through valuation revisions? They say, I'm getting pushback from consultants who fear volatility spikes when the assets are marked to market. So evidence that the daily valuation methodology doesn't significantly affect volatility would be helpful here. Does anyone have anything to add on that question?
Yeah, I think that's something that definitely existed when we first considered adding private real estate to DC plans. And I won't say how long ago it was, that will really age me, but there was an obvious jump when the valuations came in. And if anyone was aware of how the market worked, they could kind of time that. So that was something else that needed to be figured out, or figure out that that it doesn't make sense for it to be a participant directed type allocation. But there are a lot of firms that have changed their whole valuation process. So it's not, we wait till the end of the quarter, all valuations get booked on the same day, and you have a big up or a big down or whatever it might be. So all of the different adjustments that are making, whether it's for leasing activity or for sales and acquisitions, et cetera, various things that would affect even market conditions, just like what we saw last year, it happened in the middle of March. Those types of adjustments, as people get more comfortable for those things happening mid-quarter, a lot of these funds and the types of investments we're talking about are valued quarterly, really helps to have a more comfortable view of the fact that the valuations are going to be adjusted throughout time instead of at one point in time at the end of the quarter.
I'll just chime in a little bit on that too. Yeah, I agree with Allison. I referenced this a little bit earlier. One of the biggest things that's going to make for volatility is going to be valuation changes. But the one thing I would caution is that, if you would compare any of those valuation changes to what happens in the public markets, right? It's lower volatility than that, right? This is just direct real estate. So when you think about what the spikes are in, say, an ACRE Odyssey fund, that's the same kind of valuation dynamic that you're going to get in a CIT from just the component where you talk about, hey, did this piece of property go up in value or down in value? And one of the ways that you can smooth that is, you generally want to have a valuation done probably once a quarter. And what you can do is you can take a third of the assets and do it in January, do a third of the assets, do that in February, do a third of the assets, and do that in March. And you just keep rotating the assets, along those lines. And then what you have is you've got more of a smooth effect over time. So they're still getting valued on a frequent enough basis that you can capture upside down. So you get a pretty fair, estimate of what the value is of those properties without the end of the quarter, hey, big pop or big fall, right? And then, but you do need to also take into consideration, the other things that can make the changes. So, if you've got a 10% to 20% exposure to REITs, that's going to create really a lot of probably more valuation volatility than you're going to get from just changes in the real estate. And then, you do need to take consideration, you need kind of cash flow that happens, or if you've got sometimes, you'll sell an asset and it'll be valued at one price. And, I think probably today, if you sold any industrial asset, likely the case, maybe it's going to be selling for higher than it's being valued at currently. And, you're going to get a little pop there. That's going to be potentially pretty meaningful.
And I just want to remind people, we have a Q&A button to submit questions, and I have a few more coming in, continuing to focus on these questions of liquidity. Here's one question. Could the secondary market for shares in real estate funds increase liquidity? For example, by shortening redemption and subscription queues for core funds?
I'll chime into that one too. Yeah, I mean, to the extent that you basically create some kind of vehicle, generally a collective investment trust, that's going to be feeding into, say, an ACRE Odyssey fund, that's just another flow of capital either in or out, right? And that's where, you probably need to take a look at when people say like-minded investors, and, do the institutional investors like to be investing alongside, retail investors? And there's kind of two schools of thought again of that, right? On one hand, people say, okay, well, no, the retail investor is a little bit more reactionary, where the institutional investor takes that longer term view. On the other hand, I think my experience has probably been a little bit of the opposite, which is that the retail investor usually kind of takes the money, they park it, and they go away, and they just say, hey, things are going to be what they're going to be. Because typically, if you do have some sort of a crash scenario, it's oftentimes the case that everything else is kind of like, going down. If you got a recessionary environment, they don't really know where to put the money. So it's not like there's some other screaming obvious place to put that money.
Allison, Josh, want to weigh in here on the secondary shares?
Yeah, I agree. Obviously, more trading activity and platforms that you have, the better liquidity that we would have in the market.
Yeah, same. I mean, we are actually looking at that now on our platform as well.
And here's another question from the audience. Can you speak about real estate in the interval fund structure? What might be pros or cons to perpetual REITs or public REITs? I want to talk interval funds.
Well, I can speak a little bit. We have some exposure with interval funds, but most of the interval funds that I'm aware of are multi-manager platforms. So, a little bit different, more like the CIT type structure that Sean was referring to. They're not CITs, obviously they're interval funds, but they don't invest in direct real estate holdings. They invest in underlying funds, and so that therefore provides more liquidity. And they have, they have, I think, helped with the daily valuation and the methodology, because they've had to come up with ways to make sure that they have a systematic approach to striking an NAV on a daily basis. So I think that, in that regard, they've definitely helped add more education and thought around some of the hurdles that we're talking about in regards to adding private real estate to DC plans.
Let's talk a little bit about the fiduciary risks. Sean, you've talked a little bit about the CIT plan. This is another question from the audience. What about the risks associated with the 338 fiduciary that offers the DC plan?
Well, from my perspective, the risk that they've got there is they've got to make sure that, they're, first of all, providing an appropriate investment solution for whoever's coming into capital that's being introduced into the CIT. And they've got to do the underwriting on the investment that they're going to be making. So, when Josh was talking about somebody coming in and kicking the tires on the underlying fund, that's certainly the case, right? You get a full due diligence examination on the underlying fund, because they're going to have a pretty high fiduciary responsibility in what they're investing in.
Anyone else want to talk about the fiduciary roles that you see and how that might be different than what you might see in the defined benefit world?
I think, unfortunately, the DC world is just more litigious than the DB world is. And so, it's something that has to continue to figure out what the requirements are around education and in regards to the employer that's sponsoring the program. But there's definitely been some strides made in that regard to provide more information about what the requirements are and what the obligations are. So hopefully that'll continue to evolve.
And we found some comfort in the DOL clarification letter of June of 20 that came out. But to Allison's point, you just have to look at P&I and see the number of ERISA lawsuits that are going on for a lot of major corporations. There have been some favorable rulings, but nonetheless, it doesn't take that out of the equation, I don't think, totally.
And is this a bigger risk for investing in private real estate than in other asset classes? Is there more of a fiduciary question of why are you doing this? I'm just kind of wondering what kind of challenge this is posing.
The big one for me, I think, is probably going to be if you get into a lock situation where liquidity is just not available, right? And why did you get, in hindsight, why did you go into that? That wasn't a good investment. You weren't able to sell it when the downturn came. I need my liquidity, and that becomes a significant problem.
Josh, did you want to weigh in there as well?
Yeah, I think there's also, and I guess this is a question that I don't know if anybody can answer, but philosophically, right, DB plans are managing to a return target. DC plans don't necessarily have a return target, right? And it may just, I guess my question is it a case of more avoiding risk than having, if we did have a return target in DC for a target date fund, would that open the doors more up for private markets? Because it seems as though the fear of litigation tends to drive maybe some decision making, at least in my experience in talking to some clients and prospective clients, that there's quite a bit of fear of litigation out there. And I guess my question is if there was a return target and you were held to that, would that change perspectives at all in DC?
And I have someone just agreeing in the Q&A that yes, there's much more risk, fees, valuation, and liquidity. Sort of echoing what's being said here. Here's a question that I'm not sure if we have the answer. Maybe one of the later panels might have an answer to this. Does anyone have a sense of how large the daily valued private real estate market is? Also, how much of that are DC plan assets under management?
Yeah, the number that I know of is 50 billion in private real estate in DC. I don't have the breakdown in front of me, but there's a little bit more info on that. But and I don't know if Sean or Allison knows anything differently more on that. But from what I understand, it's about 50 billion in private real estate currently.
I don't have any details on that. I mean, the number that I kind of think of is you're playing for about 7 trillion of overall DC money, right? So if you can get your fair share of that, right, that can be a pretty large amount. And if it is 50, if you're talking just about 50 billion, right, I would say there's probably still scope for that number to increase very significantly if you were to have, the amount that DB plans invest in real estate, right? If you think like an average plan saying, hey, I might be at the low side, 5%, at the high side, 15%, average being 10, right? That feels like a pretty decent place to be. Right. And if you've got $7 trillion, you're talking about $700 billion as opposed to the 50 that Josh was referencing.
Yeah, the scope to the scale potentially here is quite large.
Yes, and growing, right? So
I have a question for my fellow participants, panelists on this. Do we think, given the bull market run that we've seen in equities, that this whole conversation of adding private real estate to DC plans has gotten even more difficult? A lot of individuals think all I have to do is just invest in the S&P 500 or pick one of the equity market options and I'm going to make 20% a year.
The idea, like, why even bother with private markets? Public markets are doing just fine here.
Right.
Yeah, I mean, I would imagine that absolutely does come across people's desks, right? As in terms of an argument for why you wouldn't do it right now. You add the complexity of it, any of the potential risks associated with it. Hey, why would we do this right now? I think real estate does, on a relative basis, shine during the downturn. So, for example, if you've got, when you take a look at what sort of real estate does in a target date fund, for example, and what it did do during the COVID period, right? So the equity markets were just plummeting, but you really had real estate kind of acting as a ballast to that, even if it was just 5% of the overall portfolio. And the people who are managing those target date funds are looking at that going, all right, this is actually really positive. I like that. And and this is a dialogue that we have with a lot of the target date funds with whom we work. And and then in the flip side of that, if they've got it in the investment pool already, is when the reverse happens and the equity markets come roaring back, they say, I understand, but it did what it was supposed to do. It lowered the volatility and it pushed out that efficient frontier for the overall portfolio. And so if you see it across a cycle, they're going to be, during that down cycle, that's when it's going to shine and I think really deliver what it's supposed to be delivering. And when the equity markets are popping, right, you're going to have relative underperformance. But if you do have a situation where the equity markets are popping, hopefully that also means you're in some sort of a positive environment where real estate's also, it's not going down. Hopefully it's, you've got some decent performance coming out of it as well, which you still, you do right now in generally speaking in real estate.
Yeah, Josh, you wanna add on that?
yeah, I just think also as we look at participants getting close to retirement, the need for income, I think that's where real estate can really shine as well. So clearly with the public equity markets doing what they're doing, it does make it a little bit of a harder discussion. But I would point back to the need for income as folks get closer to retirement and where target date funds or investors and clients feel they're going to get that income from successfully.
And Allison, you posed the question, but do you also have an answer yourself?
Well, I think it's just that we need to continue to make sure that asset allocation, which is something that, is common language in the DB world, is still considered and that process is utilized in the DC space as well.
Yeah, that's a great point. I mean, it seems like the same kind of reasoning and logic that applies, or at least in the back of my mind, it's always been the case that the same progression that the DB plans have gone through, right? And they continuously up their real assets exposure. They continuously up the amount of real estate they're doing rather than lowering it. And it's because they continuously feel like they can push it, hey, another percent or another 2%. Sorry, I'm going dark here, guys. But I'll get the light back on in a second. But I think, we'll see the same kind of progression as people get comfortable, see it across cycles, and decade by decade. I think we would expect to see that the percentage allocation rise.
I just thought you were trying to plan for Halloween, Sean.
I know, it's a little spooky here. I'm getting
Well, we've only got about 10 minutes left on this panel, so we'll see if we can keep you from getting too in the dark. I'd like to maybe go around and kind of think about some of the key takeaways and some kind of important things for an audience to understand coming out of this first panel. So I'll start with Allison. What do you think the audience should take away from this panel and this conversation that we've had up to this point?
Yeah, I think all the things we talked about, and that we all know how much the DC market is growing, and that's going to continue, that this is an area as an industry we need to continue to focus on. We need to continue to evolve our products that are offered and our thought process around this, and make sure we understand regulation and rules, have very good processes around how to effectively add private real estate to a DC lineup, and just to continue to evolve the use of private real estate in the DC world.
Go to Sean.
Yeah, I think one of the kind of the critical things for us to do is to think about standardization around best practices, right? So the thing that's making a lot of people scared, definitely lawsuits are top of that list. And one of the defenses against it is there's a reasonableness standard, and if you're doing something that everybody else is doing and it's well thought out and it's therefore reasonable, that can be a good protection and can accelerate the kind of exposure that we bring into into the DC plans to real estate. And again, I'm reasoning by analogy to what the DB plans are doing, and if it's good for the DB plans, there's not too much of a dissimilarity between the two. It can be beneficial and should be beneficial for the DC investors as well. And I think that's one step that can be executed to help facilitate the speed with which real estate's brought into the DC world.
And Josh.
Sure. So my big takeaway is that the DC market continues to grow. It will be as I mentioned earlier, will be the primary source of retirement income and savings for the bulk of Americans. And that as you look at the number of transactions and folks that actually trade or make daily changes on their 401k, it's usually under one per year. So you're seeing a lot of capital flow into the QDIAs, right? And it's set it and forget it, and folks are not going back to it. So, and that's really I think a multi-asset strategy really is the natural home for private real estate. So I'd like to think that as we evolve and as the market continues to grow, to Allison and Sean's earlier points, what's been good for DB, it should be good for DC as well, and especially in an environment or in a strategy that has a fiduciary on top of it that's overseeing. You don't have participants moving their money in and out. It's a fiduciary on top, managing it similar to a DB plan would be done. And I think that's a natural fit for private real estate in those broader multi-asset strategies. And I'd like to think we see the exposure to continue to grow as we evolve and the market matures.
Yeah, I want to thank the panelists. This has been a great conversation. I am very optimistic and very enthusiastic about this topic. The numbers don't lie. the defined benefit pension world is shrinking. The defined contribution world is growing. It seems like there are some real reasons to invest in private real estate. DBs have been doing it this whole time and gaining benefit from that. And so finding a way for participants in DC plans to also take advantage of that opportunity. This is a huge evolution. This is such a positive, I think, for individual retirement accounts. So, I'm excited by this conversation. We're gonna keep it going with the next panel, but we're gonna start by thank you, Allison. Thank you, Sean. Thank you, Josh. This has been a great start. Thank you.